This might be one of the most uncomfortable stocks to own today. It's Chinese. It's in education, and most investors want nothing to do with it. But sometimes the best opportunities are hidden exactly where discomfort is highest. Hi, investors. You're watching Victor Value. On this channel, I document my personal journey as a long-term value investor. This video was assisted by AI, but the thinking behind it is entirely mine. I want this to feel human, not polished, and not promotional. The company is EDvantage Group, ticker 382 HK, listed in Hong Kong. The first reason most investors avoid it is obvious: China. More specifically, private education. After years of regulatory pressure, many investors simply walked away from the entire sector. Not because every business failed, but because uncertainty became uncomfortable. Add to that a small market cap, low liquidity, and very little international coverage, and you get a stock that most investors never even research. From a fundamental perspective, EDvantage looks cheap, but what really matters is not the multiple. Despite all the challenges, the business stayed operational, kept enrolling students, and continued generating cash. That tells me this is not a broken business. While researching EDvantage, I found an article from 2019 predicting the collapse of private education in China. Years later, the company is still here, still operating, still producing cash. That gap between expectations and reality is where value investors often find opportunity. Another important point is cash flow. Even if the stock price goes nowhere for a while, the business itself keeps working. Dividends mean part of the return comes from ownership, not market optimism. That doesn't remove risk, but it improves the odds. Now, when it comes to price, I'm not looking for perfection. I'm asking, what has to go right for this investment to work? At today's valuation, the market seems to assume long-term stagnation or worse. If that extreme scenario does not happen, the downside looks limited, while the upside becomes asymmetric. If the company simply survives, keeps generating cash, and avoids major regulatory shocks, today's price already makes sense. Let's be clear, this is not a safe stock. The main risk is political and regulatory. Rules can change, and minority shareholders are not fully protected. There is a real chance this turns into a value trap. I would reconsider this investment if regulation becomes structurally hostile again, or if cash flows deteriorate permanently. But as long as the business remains stable and cash generative, the thesis stays intact. This is how I think about deep value investing, not chasing excitement, but buying resilience at a discounted price. And whether this turns into a success or a mistake, the process behind it will matter far more than the outcome. Quick summary. EDvantage 382 HK is cheap, cash generating, and misunderstood. It's risky, but the current price offers an interesting risk-reward balance for patient investors. If you're interested in long-term, process-driven investing, you can subscribe to follow Victor Value. Before you go, I'd really like your perspective. What do you think about EDvantage? Is it a misunderstood deep value case or a value trap in your view? And if not EDvantage, which overlooked stock, would you analyze instead? Thanks for watching.